Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi. We have just released our monthly India Market Outlook titled is Value Emerging. In today's podcast, we discuss the implications of markets' reassessment of a higher peak monetary policy rate on major asset classes. Since the start of 2023, markets had become a bit optimistic over the prospects of a peak in global central banks' policy rate given early signs of weakness in economic output and demand indicators. Bond yields retraced lower from the 2020 peak and risk assets had staged a strong rebound. However, strong economic data, especially on services sector across developed economies, despite the fastest pace of central bank policy tightening in many decades, has revived shorter-term inflationary expectations and subsequent central banks' tightening concerns. This reset of higher terminal policy rate expectations has triggered a fresh bout of volatility in global assets. Global bond yields, including the Indian bonds, have risen from the 2023 lows, while the equity markets have consolidated from their respective 2023 peak, having rallied sharply since November. The US dollar, or the DXY index, had risen 4% from its 2023 low. In our view, elevated inflation against the backdrop of historically tight job markets is likely to encourage the US Fed and the ECB to push for higher for longer rates. Market expectations now appear to have better aligned with the central bank's guidance compared to fourth quarter of 2022. In our view, the RBI is likely to raise the policy rates by another 25 to 50 basis points in first half of 2023, given historically low policy rate differential with the US Fed and the recent increase in domestic CPI above the RBI's upper bound target of 6%. This backdrop gives us confidence that the macro environment remains consistent with our SAFE strategy: S for securing your yield, A for allocating to assets offering long-term value, F for fortifying against future surprises, and E for expanding beyond the traditional. The key implications across major asset classes are as follows. First, Indian equities valuations trade reasonable post recent underperformance. In our Outlook 2023, we had highlighted that India's stretched valuation premium, both absolute and relative to peers, as a key risk to Indian equities' relative performance. We believe the risk-reward has improved for Indian equities given the following. 1. Indian equities' relative valuation premium has narrowed post the sharp rebound in Chinese and Asia ex-Japan equities since November 2022. The MSCI China and MSCI Asia ex-Japan indices are up 38% and 20% respectively versus the Nifty index decline of 2.7%. Second, the 12-month forward price to earnings ratio for the Nifty index is around 18x, which is at 7% premium to its 10-year average compared to the peak valuation of 23x in October 2021. The earnings yield gap, which is the difference between the 10-year Indian government bond yield and the reverse of Nifty index's 12-month forward price to earnings ratio, has fallen to 1.9% from 2.3% in October 2022. And finally, the corporate earnings cycle in India remains strong, with the Nifty index consensus EPS growth at around 12% and 15% respectively for fiscal year 2023 and 24. This is on the back of a strong 35% and 15% earnings growth delivered in fiscal year 2022 and 2021 respectively. The second implication is on bonds that now offer an attractive income opportunity. After trending lower till mid of February 2023, domestic bond yields have risen in line with their global counterparts as markets reassess their inflationary expectations higher in price and subsequent policy tightening by central banks. The rise has been sharper in shorter maturity bonds, with the 3-year and 5-year Indian government bond yields rising by 30 to 35 basis points, while the 10-year Indian government bond yield is up 16 basis points. We believe bonds offer an attractive income opportunity, especially shorter maturity bonds, with an attractive yield on offer due to the following reasons. Shorter maturity bond yields have responded to upward shifts in RBI's policy rate expectations, as the 2-year and 10-year IGP yields are up 46 basis points and 22 basis points respectively since Feb 2023. This indicates that short-term yields are pricing in further incremental rate hikes by the RBI. Second, Bond yield curve has flattened since the start of policy tightening cycle in 2022, with the 10-year and 2-year Indian government bond yield spreads at 5 basis points versus the 10-year average spread of 105 basis points. Third, fiscal year 2024 union budget is unlikely to be inflationary given fiscal consolidation and, more importantly, improvement in the quality of spend. Further, supply pressures are modest given a small increase in government borrowing plan. The third implication is on gold and cash, which remain key portfolio hedges. We highlighted in our Outlook 2023 that investors need to prepare for downside surprises given the challenging global macro backdrop. The recent surge in volatility reinforces our belief that a defensive portfolio positioning through neutral allocation to cash and gold remains a prudent approach. Cash yields have continued to rise alongside shifts in RBI's policy rate expectations, which is trading at a 4-year high of nearly 7%, up 44 basis points since Feb of 2023. They provide a hedge not only against rising interest rates, but also serve as dry powder for any tactical opportunity that may arise due to intermittent market volatility. Gold has pulled back in recent weeks as both bond yields and the USD have rebounded, living up to its negative long-term relationship with the US bond yields and the US dollar. Gold's diversification benefits remain attractive, particularly against inflation and the risk of short-term market volatility, which could get triggered by slower global growth, geopolitical risk, or concerns on corporate earnings performance. That's it in today's podcast. Do reach out to your relationship manager for a copy of our India Market Outlook. Thank you as always for listening. If you enjoyed this podcast, please like and subscribe.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.